what to look out for and how do you find them? I mean, these properties are everywhere. You don't want to be doing like, I've got no real interest in doing extensions and, massive refurbs. You're just doing light refurbishments. So for me, that's new kitchens, new bathrooms, new carpets and decoration. That is literally it. Every now and then we might knock a wall through and create an open plan area, or we might seal a wall up and create an extra bedroom. But we're not adding months and months worth of work with extensions. We're just in and out to try and get the team in and out within 4 weeks. So you basically, when you're scrolling, you're looking for not the prettiest things in the world. And, these dated sort of greeny carpets, blue carpets, red carpets, sort of old-fashioned kitchens, wood bathrooms, and you're just trying to look for nasty. I call them nice and nasty because they're nasty to look at, but they're nice on the pocket. So these are where you can build a portfolio quickly. If you look at the example that we just talked about as well, there's the thick end of like 20 grand's worth of equity in that property as well. So not only is that going to cash flow in excess of that'll probably do over 8.5 grand a year, I'd imagine, net cash flow. It's also got 20 grand's worth of equity in pretty much from day one. So that's not a bad little purchase from no money invested, really, because I literally have no money in that property anymore. This is what you can turn them into, and again, it doesn't cost you fortunes to turn these properties around. If you do it properly, you get a good team behind you, and that is one of the crucial things. You do need a good team behind you. They know what's in it for them, and the costs are kept down because they know they're going to get repeat business, and they jump whenever you say you've got a property, and they come and get it boxed off straight away. They'll come back and snag anything, and you can really create some really nice looking things on a budget. So it's the strategy's easy. It's the finding the deals and I guess finding the money that has always caused problems for people. And I think most people think you can't do this if you haven't got money, but you can. You've just got to find out who has the money. So obviously yourself, if you do have a small pot of money or a medium-sized pot of money or a large pot of money, there's various ways that investors invest. Not everyone does BRR. Some people just want to invest their capital and get an 11% return on it, and they're quite happy just leaving their money in there. Others like myself want to sort of build as many units as we possibly can and just continue to grow the equity and grow the asset portfolio and grow the cash flow. There's loads of different strategies. So, but if you have got money and you want to do it, then you can probably start with a pot of 20 grand, and you could quite easily keep sort of rinsing and repeating that. Your parents, some of you might have or might not have, and also some of you might not know or might know, because some people are quite open with their finances with their parents and some people aren't, and vice versa. And once you start doing this, all of a sudden your close family want a bit of the action. So it does surprise you sometimes who raises the hand. Other family money, same thing. Once they start seeing what you're doing, and a lot more people start asking questions, and all of a sudden someone tells you they've got 50 grand sat in a savings account doing nothing for them. And this does happen all the time. And I come onto it all the time with the mentees, but document your journey. Always document your journey on Facebook, on your social channels, because when people start seeing what you're doing and they're seeing that the success that you're having, they want a bit of it. So they will start to ask how they can get involved, and them getting involved could be the difference between you acquiring another 5 units a year, another 10 units a year. You just don't know how much money they may or may not have, but you'd imagine if they're asking to get involved that they've got a little nest egg tucked away that maybe isn't doing too much. As we know, the interest rates have just gone down again, and they're not going to be moving far. So money in a bank these days does absolutely nothing for you. So people are always looking for alternative investment strategies, and for me, there's nothing safer than property. And if you do this process and you're good at this process and you can demonstrate it, then you give them the trust and the confidence to actually part with their money and give it over to you. You can give them first charges on properties for security and things like that as well. And obviously investors, there's plenty of investors that have no interest in, putting the hard yards in and doing all these projects and managing them and, making sure that it all works out and, bothering with the mortgages and the applications, etc., etc. They literally just want a return on their money. So if they give you 100 grand, they want X amount back in the quickest time possible. And then more than likely they want to do it again and again and again. So there is plenty of money out there. And you can always get involved in BRR, even if you haven't got that initial pot of money. I'm always a fan of find the deal first and money you will find, or the money will find your deal. Because I think if you come up with a good BRR deal, that is a pretty much full cash out and equity created in a property, then why wouldn't a savvy investor buy that deal or invest with it with it? So find the deal first, even if you feel like right now you're sat there and you're thinking, well, I haven't got 15, 20, 25 grand. You can still go out and hunt these deals down, and you just never know where it'll take you. So when you fund your deals, it's, because finding the deals is one thing, obviously doing the project management's another, but really getting your head around the finances is how you, and the numbers that is crucial. I come from sort of a financial advising background, and I was a mortgage broker back in the good days, and so I kind of understand numbers and I understand how products work. And if you don't, I would suggest that you do. You don't have to become a qualified advisor or anything, but just start understanding how mortgages work, how interest works, how the different interest-only repayment mortgages work, and just get a good feel for bridging loans and stuff like that, and it does help in terms of making the right decisions to make sure that you can pull this strategy off. So mortgage to mortgage, you shouldn't really do this, and I think there are a lot of people do it, but you shouldn't really use a long-term product for a short-term solution. And obviously, you're looking at, I think the quickest we've done is about 2.5 to 3 months in terms of getting the keys and getting it refinanced. Obviously, you do have the 6-month rule, which some lenders will get around, and you can do it beforehand, mainly by doing bridges first. But some make you stick the 6 months out. But even mortgage to mortgage, 6 months, you shouldn't really use that product. And I personally think there's better ways to do it, quicker ways to do it. Obviously, bridge to mortgage, this is kind of how we do it. So it's taking a bridging loan. Yes, you're going to pay higher fees, and yes, you pay a higher interest, but you can get them refinanced off, as I said, within 2.5 to 3 months. So where I might pay, if I was to do mortgage to mortgage and I was going to acquire one property every 6 months and pay less fees by maybe a couple of grand. Well, if I can do a bridge to mortgage and I can acquire 2 properties in the same time frame, yes, I might pay maybe 2 or 3 grand worth of fees on more, but I could have 2 cash flowing units that have got 2 chunks of 20 grand equity in them. And, but between them, they're going to make me anywhere from 15 to 18 grand a year in terms of cash flow. Now, I'd rather use the money that way, because for me, I actually think if you break the ROI down and your total spend, by doing it that way is much more efficient than doing the mortgage to mortgage. Obviously, you can cash to mortgage, so it's the same as bridging really, but effectively, rather than, I guess in the example I've just shown you, putting down a 30% deposit and getting a 70% bridge from a lender, which does still have a bit of time lag involved in it. If I could have just put down the full £52,500 and I could have then just bought it a lot quicker, and then we could have got the refurb done and I could have refinanced it straight off. Why I don't do that, again, is I am all about trying to multiply as quickly as I can. So I'd rather buy 2 houses with 2 sets of deposits rather than buy one with using a lump of cash. But it's another good way to do it. And obviously, if you've got the money there, or you can get your hands on the money by someone investing in it, then it's a quick way to do it. Investor loans, that's exactly kind of what I'm talking about there. So, you know, there might be an investor who will say, listen, I'll give you the 52.5 grand instead of you paying, you know, 1.2% or whatever the rate is per month on your bridging loan. You know, just give me 1%, or, you know, you might do a fixed 8% per annum and break it down monthly, however you do it. Investors want return on their money. If they've got money sat in the bank, this is where you can pitch to them and you can say, listen, I've got this deal. This is what's going to happen. This is how the numbers are going to stack up. I need 52.5 grand for the best part of 3 to 4 months. I'll pay you a 10% return on your money for those months that I've got your money in operation. At the end of it, once I've refinanced off, I'll give you 95% of your money back. I'll continue to pay the 10% on the bit I've still got borrowed until the time where I've fully paid you back through, obviously, the monthly cash flow that'll come out of the property. If you put that in the right way and the deal stacks up and you can prove that you can do this, then you will get investors buying that and lending you the money. Alternatively, you can go into investor JVs. So, you know, I've got these with quite a few family members, and, you know, whereby they, you know, seen what I've done. So they want a bit of the action. So rather than me just, you know, using their money and just giving them a percentage back, I kind of, which would have been the better way for me to do it if I was, you know, greedy and selfish. But, you know, I'd rather see everybody benefit from this. So I just decided, well, I'll bring the experience, you give me the money, we'll put it all together, and at the end of it, we'll just put everything 50-50 down the line. So you'll get your money back, we'll have a property that we own between us, and we'll split the equity, we'll split the cash flow. You know, because at the end of the day, you know, if they want to give me money, I can buy more property with it. So if I get half of something, great. And, you know, there's plenty of people that you can bring into your property business. You know, you can benefit their lives as well as your own. And, you know, again, that's a great strategy, and one that I'm pretty much doing with quite a few family members at the minute. Because obviously I want to see them, you know, utilize this strategy as well, without them having to do anything, without them having to have the knowledge. You know, so it works well. So this strategy alone has basically allowed me to do all this. So, you know, by doing buy, refurbish, refinance, I've built what I would say is just a full property business. You know, I've gone from doing sort of 0 projects to probably we try and do around 3 a month. That's kind of what I want in the pipeline. Obviously, we've got tenants in residential and HMOs. We've got lease to purchase options that we've acquired from anything from £1 up to, I think, 5 or 6 grand. You know, we've got a big service accommodation portfolio now. Rent to service accommodation portfolio, rent to rent deals. We do service accommodation management. You know, we've got a cleaning and linen company. We do building and handyman services, and then we've got the academy, and all that has come from basically, you know, just starting out in property with a small bit of money, building it up, getting a deposit, buying the first one, doing the BRR strategy, and then moving forward. So that is it. In terms of presentation wise,